by the Coburns called American Casino by Leslie and Andrew Coburn. This is Democracy Now!, democracynow.org, The War and Peace Report. I'm Amy Goodman with Juan Gonzalez.
Wells Fargo was one of the top 10 subprime lenders in the country and is among the top recipients of taxpayer-funded bailout money under the Home Affordable Modification Program. But it's also at the receiving end of lawsuits accusing the bank of unfair and misleading lending practices to minority communities and what's often known as reverse redlining. In January of 2008, the city of Baltimore sued Wells Fargo for a range of deceptive practices to push high-interest subprime loans onto African Americans in Baltimore and the Maryland suburbs, leading hundreds into foreclosure. This July, the Illinois Attorney General, Lisa Madigan, sued Wells Fargo for having, quote, transformed our cities, predominantly African American and Latino neighborhoods, into ground zero for subprime lending. In her statement, Madigan says, quote, the dreams of many hardworking families have ended in foreclosure due to Wells Fargo's illegal and unfair conduct.
In June of this year, 2 former Wells Fargo employees filed sworn affidavits with a federal court in support of the city of Baltimore's lawsuit. They allege Wells Fargo targeted African Americans for subprime loans and routinely steered customers qualified for prime loans towards subprime loans. We're joined now from Washington, D.C. by one of the whistleblowers, Elizabeth Jacobson, a former loan officer turned sales manager at Wells Fargo from 1998 to 2007. She now works in foreclosure defense. Welcome to Democracy Now!, Elizabeth Jacobson. Tell us your story. What did you do exactly at Wells Fargo, and when did you decide to blow the whistle?
I was at Wells Fargo for 9 years, and I originated loans. Wells Fargo had 2 separate divisions, the prime division and the subprime division, and you could not originate prime loans if you're in the subprime division. So that's what I did for 9 years at Wells Fargo, is originate the subprime loans. In the beginning years at Wells Fargo, when I started, there was no filter system. So if you had somebody come into your office and you could sell them a subprime loan, even if they qualified for a prime loan, that's what you did. The compensation worked out that you had a huge incentive to put people into a subprime loan. Even the prime loan officers would make as much money on a prime loan or on a subprime loan, referring it over to the subprime division, than they would make doing a prime loan. So there was an incentive for the prime loan officers to refer the business to the subprime side. And as a company, Wells Fargo pushed the subprime loans because it was their goal to have the subprime division pay for the fixed costs of the whole company. So there were quotas to be met. Wells Fargo puts out this projection that when somebody walked into a Wells Fargo office, they got put in the loan that was best suited for them. What happened was whoever happened to be the loan officer at that time would put them in the loan they felt was best for them, and usually that meant how much money they could make off of the loan.
And what were the differences in the incentives for employees in terms of putting someone in a subprime versus a prime loan?
Well, just based on the commission, you would make sometimes 3 to 4 times as much in commission if you put somebody into a subprime loan. And you'd probably be thinking, well, why would somebody that perhaps had a really good credit score that could go prime end up in subprime? So when you looked at the initial rate, the teaser rate on a 228 on a 2-year ARM, at that point, the going rate may have been 6.5%, and that would be comparable to what was on the prime side. So when you got into the subprime loan, you'd have a similar rate, a similar payment. But in 2 years, that rate was going to adjust. And the first adjustment, it could increase by 3% up to 9%, and then it could adjust by another 3% in another 6 months. So you've gone from 6% to 12%. In addition, there was points on the loan. There could be 2 origination and 2 discount points. Generally, on a prime loan, the only reason you'd pay points is if you're going to buy your rate down. But they were just selling payment. You just talked about what the payment was, and there were some loan officers out there that were just selling principal and interest payment because on these subprime loans, you did not have to escrow for taxes and insurance. Obviously, those payments had to be made, but the loan officer would get away with saying, okay, this is your payment. And so they'd be comparing it with other good faith estimates of perhaps a prime loan, and they would actually think they were getting a better deal. In reality, they were not. And what would happen, as soon as they got to the table, things would switch, or they might have thought they were in a 30-year fix, and all of a sudden they found out they were in a 2-year ARM.
Elizabeth, talk about what changed you.
Well, when I was hired by Wells Fargo, I had never worked in the mortgage industry at all. I had been a paralegal. So I took everything that Wells Fargo was telling me, that this is the way things were done. I didn't question the fact that we were putting people in a 55% debt-to-income ratio and that we're only qualifying them based on the 2 years at the lower interest rate. The whole goal was every 2 years you're going to refinance that loan. So it was sold as a 2-year loan. These people were never intended to be in the loan for 30 years. And as things started to happen in the economy, sometime around in '06, I could see that the guidelines were tightening up. And so you'd question, well, why would they tighten up the guidelines if they said that they were doing responsible lending? They got rid of stated income loans at the lower credit scores. When I first started, you could get a stated income loan with a 520 credit score. So as things started to tighten up, and the response would always be, this is what the investors require. The investors are having trouble selling this loan, or people are defaulting on this loan, so they would internally tighten up the guidelines. And then I just started to see, well, wait a minute, we're setting people up for failure, basically. And what really, the point that really made my decision that I was going to leave the company was third quarter of '07. Wells Fargo was actually the #1 subprime lender in the country. So internally, we're getting all these emails and all this information about, great job, we achieved our goal, we're #1 subprime lender in the country. And I happened to see a news report with the CFO of Wells Fargo, and he was questioned about the subprime division and denied at that point that Wells Fargo even had a subprime division. So here he is, the chief financial officer, where the subprime loans were supposed to be paying for the fixed cost of the company, and he's denying that Wells Fargo even did subprime loans. That was just the final straw of total disillusionment, and then I put my resignation in.
You were the head of the subprime division that he was denying existed?
Right. Well, I was a top producer. I was originating approximately $55 million a year in subprime loans.
And what about this whole issue that the city of Baltimore is raising about the targeting of minority communities, especially African-American communities, by Wells Fargo? What was your experience in the question of who you were told to try to target for loans?
A lot of this was information that I would receive on conference calls as a sales manager. And people on the call, the management there, would encourage the loan officers, the subprime loan officers, to go into Baltimore City and target the churches, the African-American churches, to get a relationship going with the minister or the reverend at the church, and try to get that person to schedule some sort of meeting. They would call it a wealth building seminar, to get the parishioners of the church to attend. And any loan that was funded by Wells Fargo, whether a purchase or a refinance, $350 would then be donated to the church. And so that was the incentive for the church to want to have these seminars there. But what would happen is the only loan officers that would attend these seminars were generally the subprime loan officers. And on these conference calls, at one point, somebody made a joke who happened to be a white loan officer and said, well, will I be able to go to these seminars? And they were told right there on the conference call, unless you were of color, you could not attend these conferences, these wealth building conferences. So it seemed to me, Wells Fargo didn't come right out and say this, this is just what I saw, is that they wanted the African-American Wells Fargo loan officers to sell loans to the African-American community.
And you're saying that the churches were getting, in essence, a finder's fee for $350 for every one of their church members who ended up getting a loan?
Correct. Wells Fargo did this under a program where they would donate for any homeowner $350 to the nonprofit of their choice. So I don't want for this to imply that it was only the churches. So anybody that got a loan at Wells Fargo could ask that the $350 be donated to any nonprofit. But the way that it was sold to these churches was, well, that money then will go back to your church. Have the parishioner decide, as the church is a nonprofit, that they want that $350 to go right back to that church.
I want to turn to a clip from a new documentary about the subprime crisis that opens in New York next week. It's called American Casino. It's directed by Andrew and Leslie Coburn. This clip shows the Baltimore-based Reverend Almaline Emily Wade, who lost her home.
I'm homeless, and it's just hard. It's a struggle. It's devastating. It's upsetting. It's unbelievable, but it's real. I don't have a home anymore, and I'll never forget this as long as I live. This is a house that I grew up in most of my life. I came here in 1961 with my mother and my father. I've been here a lifetime. And I went to school here. I went to junior high school, went to high school, went to college. And we used to have a church next door. and the neighborhood was just home. This was just home. I wanted to do a assisted living here. I wanted to help people, and the property wasn't in the proper condition that it needed to be. So I was advised to take the equity out of the property, some of the equity, and do a loan and start my project that way. The loan was for $28,000.